You have major questions around Russia and the war in Ukraine. We have questions now about growth in China, the tightening of monetary policy here in the U.S. and in Europe with the specter of higher rates. Why are you still constructive on the equity market longer term?
Yeah, I mean, I have been quite bullish on equity market for quite a few years. And for me, one of there really have been absolutely two key drivers over long term for stronger equity performance. One is how high interest rates can go. And right now, central banks are faced with big inflation problem, and we have very, very hawkish rhetoric coming from there. And what we're expecting is very, very front-loaded hiking cycle. However, if we look far ahead, what is market pricing in a kind of long term? It's still we probably will have negative real Fed funds for almost a decade. So monetary policy in our book is still fairly accommodative. But more importantly, right now is the corporate earnings, and corporate earnings so far have been very reliable, very strong. So equities are almost in the world of very very challenging, volatile market can offer you this kind of port of stability given the strength of the balance sheet and stronger earnings coming through. So earnings really important right now.
Okay, so earnings really important. That's a big focus for us this week, of course, Marija. Good to speak to you. When you look forward, though, and it's usually the outlook statements that get the attention really from investors when it comes to those earnings stories, are you getting any sense of how nervous we should be about the inflation that is still to come and the ability or not to pass that on? Because there are signs in certain Western economies of consumers stumbling.
Yeah, no, absolutely right. So my favorite way to get corporate guidance, which is incredibly complicated, as companies always kind of talk about it in a very kind of subjective and descriptive way, so very hard to get hard numbers. So the way we try to assess corporate guidance is to look at analyst estimates since the start of reporting season, or maybe even prior to the reporting season, what kind of analysts hear from companies. And since the start of the reporting season, I mean, we only have like a couple of weeks of it, but earnings estimates have been, and particularly margins estimates, have been fairly reliable. So margins have been fairly flat in most of the countries. So Europe is really one place where we're seeing weakness, and I suspect that's a lot to be attributed to the war in Ukraine. So supply chains are disrupted, and European companies are likely to see the highest increase in commodity prices and energy costs. Consumers are likely to be squeezed the most. So Europe is one area where we're seeing weakness in margins. But broadly, if we look broader, like US and kind of Latin Americas and kind of commodity-rich areas, Pacific ex-Japan, so margins there actually seem to be quite robust, quite stable. So I think broadly speaking, it's still okay, and I think we're kind of relying on the still cash saving and strong corporate balance sheet to offset the rising costs, but that's definitely not true everywhere.